Listen, right now as we head into 2026, central banks around the world are accumulating gold at the fastest pace in decades. Not gradually, not cautiously, systematically, month after month. Institutions that manage trillions of dollars are moving massive capital into physical gold, while the mainstream financial media barely mentions it. At the same time, every major bank on earth has just released their price forecasts for precious metals in 2026. JP Morgan, $5,000 per ounce for gold. Goldman Sachs, $4,900. Bank of America, $5,000. Citigroup for silver, $60 to $72 an ounce. These aren't fringe predictions from YouTube doomsayers. These are the people who move markets. And they're all pointing at the same direction. This is not normal market behavior. This is not cyclical. This is not random. This is stage 3 of a pattern that has repeated through every major financial crisis in the last 100 years. And if you recognize what stage you're in right now, you can protect yourself and position yourself to thrive in what comes next. If you don't, you're going to get caught flat-footed like millions of others. By the end of this video, you will understand exactly how much gold and silver is actually enough for 2026. You will know why most people's answer is completely wrong. And you'll have a clear, actionable playbook for what to do before the door closes. Every crisis follows the same 4-stage pattern. Understanding it is the difference between disaster and opportunity. Stage 1 is establishment. The system gets built. Everyone agrees on the rules. Trust is high. In precious metals, this is when the dollar was backed by gold. When a promise meant something. When you could walk into a bank and exchange paper for the real thing, this stage can last decades. It feels permanent. It never is. Stage 2 is manipulation. The cracks form underneath while everyone looks away. Promises get made that can't be kept. Hidden leverage builds. In the 1960s, the US government was running deficits. They were spending on wars, on space programs, on social programs. More dollars were being printed than there was gold to back them. But instead of admitting this, they did something brilliant and deceptive. They created something called the London Gold Pool. 7 nations, including the United States and Britain, coordinated to dump gold onto the market whenever the price threatened to rise. They kept gold artificially low by promising to defend that price. Sounds stable? It was the opposite. They were burning through gold reserves that couldn't be replaced. The system looked fine on the surface. Underneath, it was hollow. Stage 3 is the squeeze. Reality hits, supply tightens, demand spikes. The paper promises suddenly matter because there's not enough real stuff to back them. By 1968, the London Gold Pool had drawn down so much gold that everyone could see it was ending. In a single week in March, the pool officially dissolved. The market rushed to price gold at the real level. It exploded higher. This is the stage where careful observers panic. Most people are still sleeping. They think everything is fine. But the institutions, they're already moving. Stage 4 is the break. The system cracks. Rules change mid-game. Official prices diverge from reality. Promises get rewritten. New systems get hastily constructed. Chaos. Opportunity. We are in stage 3 right now. And we're standing at the door of stage 4. Before I show you where we are, you need to understand why gold and silver matter like nothing else. Gold and silver are not just another asset. They're not another investment. They're the only forms of money in human history that have survived every collapse, every war, every debasement, every default. For 5,000 years. Not because of sentiment, because of physics. You can't print gold. You can't vote it into existence. You can't create it out of thin air. It's finite. It's real. And when every paper promise fails, it's still there. Think about what depends on the stability of money and trust. Every pension, every insurance contract, every business that takes a deposit, every government bond, every salary that's promised to you next year. The entire foundation of modern civilization rests on the assumption that promises made today will be honored tomorrow. But here's what's happening right now. Central banks are abandoning that assumption. They're exiting dollar reserves. They're buying gold. Russia, China, India, Saudi Arabia, the UAE, Mexico, Poland, different continents, different political systems. Same move. They're signaling that they don't trust the current system anymore. Meanwhile, physical silver inventories have been drawn down by industrial demand, solar panels, semiconductors, renewable energy infrastructure, at rates that are structurally unsustainable. You can't print more silver. You can't policy it into existence. You have to dig it out of the ground, and that takes years, and demand for it is only rising. Stage 4 looks like this. When the pressure releases, you'll see sudden moves in precious metals prices that feel extreme, halts and restrictions on trading in certain channels. Rules changing, leverage limits being imposed, position caps, new reporting requirements. Then, as the stress deepens, you'll see something more dramatic. Certain forms of precious metals trading will freeze. Allocated gold that's supposedly set aside for you in a vault somewhere, will start to diverge in treatment from unallocated gold. Delivery times will extend, Premiums over the spot price will widen dramatically. The assumption that you can instantly convert paper gold into physical, that assumption will evaporate. For ordinary people, this looks like sold out signs. Premiums so high that the official price becomes almost irrelevant. Long waiting lists, fine print that suddenly matters, rules that separate you from what you thought you owned. Supply chains will fracture. Dealers will have shortages. Getting physical precious metals will become difficult, expensive, and slow. Getting silver might be even harder than gold because of its industrial use. And the people who say, I'll just buy it when I really need it, they'll find out it's not available, or it's available at prices so high that the opportunity has passed. But, and this is crucial, for people who saw it coming and acted now, in stage 3, while access is still easy and costs are still reasonable, they're protected, they're safe, they might even be thriving. Here's what you need to do. First, understand the difference between real and paper. Paper gold is convenient. It's cheap to hold. It's liquid. But it's a claim on gold held by someone else. It depends on the infrastructure staying stable. When that infrastructure cracks, paper claims fail. Physical gold is different. You hold it. It's yours. No intermediary. No counterparty risk. No promise from a failing institution. Same with silver. In 2026, this distinction will matter more than it ever has. Second, choose the most robust forms. If you're going to own precious metals, own the most straightforward, universally recognized forms. Bullion coins, U.S. Gold Eagles, Canadian Maple Leafs, Austrian Philharmonics. For silver, American Silver Eagles, Canadian Silver Maples. These are liquid, recognizable, and when the system seizes, they'll be worth their weight in the new reality. Do not buy rare coins. Do not buy collectibles. Do not buy leveraged ETF positions. Do not buy allocated gold stored in a vault in a jurisdiction you don't control. Those are all fragile. Third, act now while access is still easy. Right now, premiums are elevated but manageable. Dealers have inventory you can buy. In a few months, when this becomes mainstream panic, you won't be able to. Premiums will spike 30, 50, 100% or more. Dealers will be sold out. The time to buy is before everyone else realizes they should buy. Fourth, think in allocations, not absolutes. How much is enough? That depends on your circumstances. But think in percentages, not absolute numbers. Many advisors suggest between 5 and 20% of a diversified portfolio in precious metals. Some suggest more during periods of extreme monetary stress. The point, a meaningful allocation that you can stomach holding without panic selling when it moves violently, but not so much that you're gambling with your survival. For 2026, given the forecasts and the stage we're in, I'd argue for the higher end. You're not speculating, you're insuring. Fifth, decide on storage. Physical precious metals only work if you can actually secure them. Home storage, you decide. Private vault, more secure, but you trust the operator. Bank safe deposit box, accessible, but the bank decides if you can get it. The key, you decide where it is and you can access it. Not an administrator, not a broker, you. Sixth, start now. Don't wait for perfect entry. There's no such thing as perfect timing to buy insurance. You buy it before the fire. You already know the fire is coming. Spot prices might move 5, 10, even 15% in the coming months. But missing the trade entirely because you waited for a pullback is catastrophic. Buy now. Buy regularly. Build your position through 2026. Step back for a moment. Gold and silver aren't isolated phenomena. They're one symptom of something much larger. The entire global monetary system is in flux. Currencies are being devalued at accelerating rates. Governments are running deficits that are mathematically unsustainable. Debt levels are reaching extremes that have historically only been resolved through inflation, default, or war. Central banks know this. That's why they're buying gold. That's why emerging markets are moving away from dollar reserves. That's why nations are repositioning their financial strategies. This isn't conspiracy. This is institutions protecting themselves against the inevitable. Throughout history, every fiat currency, every currency backed by government decree rather than real assets, has eventually failed. The average lifespan is about 50 years. The dollar's fiat era started in 1971. Do the math. We're at the edge of that timeline. And 2026 could be the year reality stops being deniable. Here's the choice in front of you. You can recognize the pattern. You can understand that we're in stage 3. You can act now while access is easy, costs are reasonable, and you can position yourself for the transition ahead. You can own something real. You can own something that can't be printed or devalued or stolen through policy. You can be prepared, or you can do nothing. You can assume it will work out. You can trust that the system will keep functioning the way it always has. And later, maybe in Q2, 2026, maybe in Q4, maybe when the rules suddenly change, you can say, how did this happen so fast? The choice is yours. But the pattern isn't. The pattern is playing out. We're in stage 3. Stage 4 is coming. Subscribe now. Hit the notification bell. Because the next video is going to break down the currency side of this crisis. What is really happening to the dollar? Which countries are actually preparing? And how the monetary system is being deliberately reconstructed around you while you sleep. The pattern doesn't stop with gold. It touches everything. And once you see it, you can't unsee it. The question is, will you act before everyone else does? The structural imbalance is undeniable. Demand is accelerating. Supply is tightening. And the institutions that understand the game are already moving. You can't just print this. You can't vote it into existence. Physics doesn't care about your confidence. Let me show you how this pattern played out before, because once you see it, you understand exactly where we are today. It's March 1968, London. The US government is panicking. The London gold pool is about to collapse. The central banks have been dumping gold onto the market for years to keep the price pinned at $35 an ounce, but the math no longer works. They've burned through massive reserves. Everyone can see it's ending. On March 17, 1968, the US Treasury and the Federal Reserve call an emergency meeting. They make an announcement that shocks the world, the two-tier gold system. There's now an official price, still $35 an ounce, where governments trade with each other. But there's a separate market price, the real price, where gold was actually trading at $40, then $50, then higher. The message was unmistakable. The official promise is dead. The rules are changing. We're going to have 2 sets of prices now. One for the people who understand the game, one for everyone else. But there's a second part to this story that's even more relevant to you. For decades before this, the US government had used silver as cheap money. They minted hundreds of millions of ounces into coins. American quarters, dimes, and half dollars actually contained real silver. But in the 1960s, as silver prices rose due to industrial demand, something shocking happened. People stopped spending the coins. They hoarded them. They knew something was wrong. The government's own silver reserves evaporated, coinage grinding to a halt, shortages in stores. The government was forced to change the composition of coins, removing the silver entirely. No announcement, no fanfare. Just a quiet default on the implicit promise that US coinage contained real silver. It was theft through debasement. The lesson burned into history. When the system is stressed, when real supplies are tight, the powerful change the rules. They redefine what's money. They separate official prices from real prices. They tell you the promises made yesterday don't apply today. And if you don't own the real thing, you own nothing. This wasn't unique to 1968. The pattern repeated. In the 1970s, after the dollar was finally severed from gold entirely, the price of gold exploded. It went from $35 an ounce to over $800 by 1980, a 20-fold increase, not because of speculation, because the system had been holding it artificially low. When that pressure released, reality reasserted itself. Same pattern, different decade, same mechanics, same outcome. The institutions that positioned early thrived. The people who trusted the official story got crushed. Now, December 2025, here's exactly where we are. We are deep in stage 3, the squeeze is on, and the data is screaming it. Central banks have accumulated gold at the fastest pace since the Bretton Woods collapse. This is not cyclical buying. This is institutional repositioning. Emerging markets are moving away from dollar reserves systematically. They're signaling that they don't believe in the current system anymore. Meanwhile, physical silver inventory levels have been drawn down by decades of industrial demand. According to recent reports, physical silver holdings that are freely available and easy to access have stabilized, but only because of aggressive restocking efforts. The fundamental issue remains. Demand for silver from solar, semiconductors, and renewable energy is structural and rising. It's not going away. Supply can't match it. For gold, the forecasts are extraordinary. Every major institution has released 2026 targets. JP Morgan, $5,000 per ounce by Q4 2026. Goldman Sachs, $4,900 by year end. Bank of America, $4,450 as an average, with upside to $5,000. UBS, breaking above $4,500 in Q3, then settling around $4,200 by year end. These aren't speculation. These are models built on central bank buying, ETF inflows, falling real interest rates, and dollar weakness. The institutions see it coming. For silver, the picture is even more extreme. Citigroup, $60 to $72 per ounce in 2026. JP Morgan, $58. Saxo Bank, $60 to $70. The World Bank, more conservative, still targets $41. These represent 50 to 70% appreciation from where we are today. But here's what should alarm you most. Copper just hit record highs, above $11,771 per ton, driven by expectations of supply shortages and new energy sector demand. The entire complex of real assets is screaming the same message. Physical supplies are tightening. Central banks are buying. institutions are positioning. And most people have no idea this is happening. We are standing at the door of stage 4. The break is coming.